Hello, welcome back. Um, so in our last video, uh, we ended. As the last in the last segment of the video, I talked about Tobin's Q, and uh, I just realized after finishing the video that um, something was not. Uh, Something wasn't right. I kind of, explained it in sometimes, I, you say something, but that's not what you wanted to say. I mean, it gets mixed up. Um, but if we go back to Tobin's Q, right? This ratio is simply, if you think about it, um, it can be it, it can be an indicator of whether the firm's asset value is overvalued, whether the firm is overvalued or undervalued. I mean, think about it. If the um, if the replacement cost, right? Um, if if this ratio is greater than one, right? That means um, the market value is greater than the replacement cost. And replacement cost, if it is, it can be greater than replacement cost can be greater than the book value or less than the book value, right? But it depends on where the current replacement cost is. The current replacement cost could be greater or equal to or less than the book value of the firm's total assets, right? Um, so therefore, if this ratio is greater than one, that means this company is overvalued. If it is less than one, it is undervalued, right? And anything undervalued is a buy target, right? Um, so in the last video, I probably uh, said uh, you should dump the stock if no, what I tried to say was, if it is overvalued, it's sell target. You have to dump the stock. If it is undervalued, uh, it is a buy target, right? Um, so that's what you used, Tobin Q for. Now, and as I said, out of three types of prices or values, market value or market price, book value, and intrinsic value, right? Book value, and I was telling you all along in Finance 100 that the book value is very solid, is based on the data, book data. In other words, income statement and balance sheet, right? Book value is very solid, based on the ground. It's footed on the ground, whereas market value is somehow floating in the air, right? Um, but then, the downside of the book value is that it is always past, because book value means, you have the you have collected data and compiled the data, and it is um, entered into the book. So then that means the data that you collected is always the past data. You cannot collect current data, and immediately reflect it in the book, right? Why? The book is, and the book means, of course, financial statements, income statement, and balance sheet, and cash flow statement, but mainly mainly the balance sheet and income statement. Now then, think about it. The books are updated how often? What is the interval for updating these, financial statements? You guys remember? Well, it is quarterly. Quarterly. It's required by law, right? You must update your book quarterly and then annually. Now think about it. You might wonder, oh, don't they? Can't they update the book, daily or weekly or monthly, even monthly? Yeah, they can. Of course, the company will constantly collect data. I mean, they will collect, that's reflected in their, ledger and, um, but what's in the, journal and ledger, it's updated daily, of course, and because you enter that, and then you settle it, weekly or monthly, right? But what I'm saying is, that is for internal purpose, right? The company's internal purpose, right? But for external purpose, what does that mean? For investors, for the public, right? Um, they have an obligation to the public or investors, especially if it is, publicly traded company. I mean, for privately held company, stocks are not traded in the market, so they don't have any obligation to release their data to the public. So for privately held company, they can update their book uh, anytime they want, and they don't have any obligation to release the data to public. But even a privately held company, I mean, it's just accounting standard accounting procedure, right? Like to update quarterly, because all these sales, right? Sales revenue, their income statement is, every company will settle it quarterly, right? And, what else? I mean, what other reason is there for quarterly updating? Now think about it. If the company is publicly traded, right, they have an obligation to report to the public their earnings, right? This is an income statement activity, right? Um, so when do they do that? They do it quarterly, right? In Finance 100, I told you this is called 10Q report, right? And then annual filing of, annual report with SEC is called 10K report. Quarterly filing of this information with SEC is called, 10Q report. Q would stand for quarterly. I don't know why annual report is 10K. What that K stands for, but think about it. That's why there is, earnings season, and every at the beginning of every quarter, right? At the mostly most of the times it's the first 2 weeks, or even the entire first month of the new quarter is called earnings season. Why? The earnings report comes out during this time. Earnings report. I mean, it comes out as early as within the first 2 weeks, but at latest by the fourth week of the first month of the following quarter. And think about it. We are already in let's say we're already into September, so still third quarter. The fourth quarter will begin October, right? And early October, right, first 2 weeks, then the earnings report will come out. But that earnings report is the earnings of what quarter? From what quarter? Third quarter, right? I don't think, I have to go, further in this, because this is, Finance 300, you already know. So basically that earnings report is based on the, previous quarter's data, right? So everything, once the book is updated at the beginning of the fourth quarter, that means, the information there is already passed, because latest information, the latest earnings data, latest financial information is as of end of the third quarter, right? The previous quarter, right? And in September, right, as we are in the last month of the third quarter, and the third quarter began in July, right? And then the most recent book data is as of the second quarter, right? So then in September, we have moved away already, right? For the last almost last 2 months and more, right? 2 months plus, we moved away from the end of the second quarter data. Market isn't at the same point. I mean, what happened? I mean, Tesla, Apple, they were all like around, 1,000 something, 2,000 something as of the end of the second quarter. But in the third quarter, they split, right? Of course, the price all gets adjusted. Pre-split prices all get adjusted to post-split price by prorata, prorated to post split price. But things like these don't are not obviously most recent book value is not reflective of most recent development in the market. So again, that's why although book is solid, we don't really, we cannot really use book value as a correct indicator, almost, rational indicator. Now, next thing is that's why we need intrinsic value. What's intrinsic value? Intrinsic value is reflecting rational expectations of cash flow from this stock. Cash flow from earnings power of this stock. So you may remember from Finance 100 holding period return, and holding period return is of course based on given data. Now we need to talk about the expected holding period return, right? Expected, right? Expected means, what does that mean? What's the difference? The difference is the expectations operator, because previously, just regular holding period return is basically based on expected. No, it's not expected, right? No, all the cash flows, accumulated cash flows. This is really hard to write like this. Let me get rid of this. And basically, you get the idea, right? We have sum of all the cash flows, right? From time 0 to now, time t, right? And then price at time t minus price at time 0. I mean, t can be 5 or 10, you know. If t is 5, right? 5 years, right? There must have been, you know, dividends, you know, paid out for, you know, over the last 5 years, right? So let me make this like, you know, to make it simple, let's call this just 5. Uh, 5 years, past 5 years, right? So holding period return based on the past data, right? I mean, if I'm standing here and now in let's say it's end of 2019, and starting from end of 2015, I have 5 years data. You know, end of 2015, 16, you know, 17, 18, 19, right? Five years, you know, price data, and I get, you know, capital gains for 5 years. That's capital gains, right? And for 5 years, I have collected, you know, dividends. So this is the idea of holding period return, and holding period can be, you know, any length of time, 5 years, 10 years, you know, 1 year, 6 months, or 3 months. But let's assume, you know, our time unit is a year. So then, you know, but then if we use, you know, expectations operator, what does that mean? We are using a forecast, right? And the forecast is based on the rational expectation. In other words, we don't have dividend at time 1. And if time 0 is now, in this case, that was 5 years ago. But if time 0 is now, time 1 is, of course, next year, right? And dividend at time 1, we don't know that. It hasn't been paid yet. But at least we can make a forecast, because this is something also we did in Finance 100. If we have the average growth rate of the dividend, right? Average growth rate, we can simply multiply we can simply multiply dividend at time 0 by 1 plus the growth rate, right? We have dividend at time. Okay. And just like that, we have a forecast of, price at time 1. And this is, really simply, by the compounding rule, right? Just like this. So basically same structure, but the only difference is that we will have an expected return, right? And also in this case, this holding period is just 1 year. Okay. So now but think, how do we then, our question is, okay, that's return, but we are talking about intrinsic value. So how do we find intrinsic value then? Intrinsic value is, this is market, this is intrinsic value, right? The symbol for intrinsic value is V, and this is the symbol for market value, market price. Okay, so the symbol for market price. And this is intrinsic, right? So think about it. When we have this formula, right? Expected return. We can just, and it has, P1. And what we want to know is, let's, I'll change that to V0 because this is what we want to know, right? Can we not isolate V0 and solve that for right? Solve this equation for V0. Right? So that's how you find the, intrinsic value based on the concept. But this is just, generic idea, generic. We already know how to, we already know there are at least, 4 variations, 4 varieties in, stock valuation models, right? Which are all called the dividend discount model, right? But all those, what are those models? There's constant dividend model or zero growth model, and 2, constant growth model or, golden growth model, constant dividend growth, right? 3, variable growth model, and 4, free cash flow model, right? So in other words, all those 4 models are basically a variation of this formula, right? In other words, if we solve this equation for V0, right? Solve this equation for if we solve this equation for V0, right? Value at time 0, that's the valuation formula for intrinsic value. But then there are 4 variations, right, in that formula. So we already know those 4 models. Now, this is just the definition of, what intrinsic value is. It's the present value of the firm's, expected net cash flows, right? Discounted by required rate of return, or K, right? Cost of capital. You understand why K, what K stands for is cost of capital, especially in this case, cost of equity. Is there, if there is anything I can do to make it easier, I would. But drawing with the mouse is such a so it's cost of equity, right? If market is in equilibrium, right? And of course, that's calculated by CAPM, right? And CAPM is, basically if everything falls on the security as the market line, right? That's equilibrium. That's when it is. So the required return or cost of equity, cost of K, cost of capital, is the expected return or fair return if priced correctly. Yes, if the expected return is, and either there are situations where it can be expected return is greater than required return, or vice versa, right? And then at equilibrium, they must be equal. But if expected return is greater, what does that mean? And if expected return is less than the required return, then it is, if expected return is greater, then it's undervalued. Stock is undervalued. If required return is less than the, if the expected return is less than the required return or cost of equity, then it's overvalued, and so on, right? So the point is, we need to look for mispricing, right? What is the the bottom line, the baseline rule of investing is look for the undervalued asset always, right? And if the expected return is greater than required return, then it's because the asset is undervalued, right? So and that's a buy target, right? Buy target, right? And then to calculate intrinsic value, we need required return or cost of equity, right? And by CAPM, if everything is if the price is correct, if it is not mispriced, required return is equal to expected return. But also, as a discount rate, we use market capitalization rate. So in other words, cost of capital, required return, they are all, discount used as discount rate, right? But also market capitalization is another name for cost of capital. So it's a discount rate. It's in principle, if the market is in equilibrium, they are all the same, right? The only reason, I'm bringing up market capitalization rate here is because of the word market capitalization. Because market capitalization means what? It's, market price of the stock multiplied by the number of stocks outstanding, right? That's usually the measure of, when they say, Amazon is now $2 trillion company. What does that mean? Market capitalization is $2 trillion. In other words, that's the market price times the number of shares. So then it may throw you off a little. What does it have to do with? I mean, market capitalization rate sounds like something related to that market capitalization. But what it means is actually the discount rate, which is a market consensus estimate of appropriate discount rate for firm's cash flows. In equilibrium, where am I? In equilibrium, market price will reflect intrinsic value estimate of, do we have more? All market participants, yeah. So that means in equilibrium, that means P0 equals, V0. That's what it's saying. But this is only in principle, in theory, because market consensus will be equal to the correct, required return only in the long run, right? Only in the long run. In the short run, there is no way there can be any consensus in the market, right? All right, so that's it for this video. I'm gonna have to stop the video and see you guys in the next video. Thank you for watching and see you soon.